Alright, so this is for the subject capital markets, and the topic for this video, common methods of measurement for investment risk management or measurement of risk. Okay, so we have here an article from investopedia.com. So to start, risk management. So this is a crucial process used to make investment decisions. So in a previous video, we've discussed the different risks and the possible ways that we could mitigate it and how different types of investors react to certain risks. Okay, so if there is exposure to risk, it's imperative that we have some sort of risk management. Okay, how do we lower the exposure to risk or minimize the effect that it has on our investment or business? Okay, the process involves identifying and analyzing the amount of risk involved in an investment and either accepting that risk or mitigating it. So we all have, a certain level of risk that is acceptable to us. And again, that would depend on what type of investor you are. If you're conservative, it's normally at a lower level. But if you're aggressive, you can accept a bit higher level of risk. Okay. But if it's beyond the acceptable level for each one of us, then we have to find ways to mitigate the effects of that risk so that we could continue or we could proceed with the investment. Otherwise, we're not going to, go ahead with the type of investment, or we're not going to take the risk. Okay. Some common measures of risk include standard deviation, beta, value at risk, VAR, and conditional value at risk, or CVAR. Okay. Key takeaways: one of the principles of investing is the risk-return trade-off, where a greater degree of risk is supposed to be compensated by a higher expected return. But again, it does not guarantee that, a higher risk would result to a higher return. Only the possibility. Alright. Risk, probability of a loss, can be measured using statistical methods that are historical predictors of investment risk and volatility. Here we look at some commonly used metrics, including standard deviation, value at risk, beta, and more. Okay. So first, we have standard deviation. Measures the dispersion, the fluctuation, the volatility of data from its expected value. So for example, your expected value is 10, but the result is 12. Your expectation is 12, but the result is 11. Your expectation is 13, but the result is 10. Okay. So you have that, difference and the dispersion of the actual and your expectation. The standard deviation is used in making an investment decision to measure the amount of historical volatility associated with an investment relative to its annual rate of return. So it indicates how much the current return is deviating from its expected historical normal returns. So for example, a stock that has a high standard deviation experiences higher volatility, and therefore a higher level of risk is associated with the stock. So, the difference between the expectation and the actual is a huge difference. High standard deviation would mean the gap is high as well. Okay, and so higher level of risk is associated with it. For those interested only in potential losses while ignoring possible gains, the semi-deviation essentially only looks at the standard deviations to the downside. Okay, so I'm not a fan of that. Next, we have Sharpe Ratio. Measures performance as adjusted by the associated risk. This is done by removing the rate of return on risk-free investment, such as the U.S. Treasury bond, from the experienced rate of return. Let's read more before I explain this. This is then divided by the associated investment standard deviation, so in relation pa rin, with standard deviation, and serves as an indicator of whether an investment's return is due to wise investing or due to the assumption of excess risk. A variation of the Sharpe ratio is the Sortino ratio, which removes the effects of upward price movements on standard deviation to focus on the distribution of returns that are below the target or required return. Okay, so essentially your inputs are the things that you include in the analysis are only the results wherein the actual is below the expectation. Okay, so that's for Sortino ratio. Replaces the risk-free rate with the required return in the numerator of the formula. So for example, risk-free rate is 4%, for government bonds. But then the required return, the investor wants at least 10% of return. Okay, so you're going to, instead of using the risk-free rate of 4%, you're going to use the higher rate, the required return, which is 10% in the formula. Making the formula the return of the portfolio less the required return divided by the distribution of returns below the target or required return. Okay. So here in Sharpe ratio, essentially you remove the risk-free investment rate. Okay. So instead of let's say the risk-free is 4% and then the expected is 12%. Okay. Since the risk-free is already 4%, essentially the risk that you've taken on is only the difference, 8%, right? That's a computation, or that's the basis, or that's the figures that they use in Sharpe ratio, okay? Another variation of the Sharpe ratio is the Traynor ratio that uses a portfolio's beta or correlation the portfolio has with the rest of the market. So it's like benchmarking. Okay, you're going to compare the deviation or the variation in one company or one investment's return. You're going to compare it with the performance of the industry as a whole or the performance of similar securities or similar types of investments. Okay, beta is a measure of an investment's volatility and risk as compared to the overall market. Okay, if it's performing near the industry average, then that's good. If it's performing below, then it's essentially a bad investment. But if it's doing better than the industry average, then that's a great decision, to invest in that. The goal of the Traynor ratio is to determine whether an investor is being compensated for taking additional risk above the inherent risk of the market. The Traynor ratio formula is the return of the portfolio less the risk-free rate divided by the portfolio's beta. Okay. Beta is another common measure of risk. Beta measures the amount of systematic risk an individual security or an industrial sector has relative to the whole stock market. So you're going to, again, compare the individual investment to the industry average, essentially. The market has a beta of 1, and it can be used to gauge the risk of a security. If a security's beta is equal to 1, the security's price moves in time step with the market. So it's, following the market movements. A security with a beta greater than 1 indicates that it is more volatile than the market. So it doesn't necessarily mean that, it's doing better than the market, but it's, the volatility is higher than the market. Conversely, if a security's beta is less than 1, it indicates that the security is less volatile than the market. Okay, so if it's less than 1, probably it's more consistent with the rates of return that it's having. Suppose the security's beta is 1.5, in theory, the security is 50% more volatile than the market. Okay, so I guess when it comes to beta results, less than 1 is better. 1 is good, and then more than 1 is concerning. Okay, it's not necessarily bad, but concerning. Value at risk, VAR, statistical measure used to assess the level of risk associated with a portfolio or a company. The VAR measures the maximum potential loss with a degree of confidence for a specific period. For example, suppose a portfolio of investments has a 1-year 10% VAR of $5 million. Therefore, the portfolio has 10% chance of losing more than 5 million over a 1-year period. Okay, so it's more about the possibility of loss. Alright. Conditional value at risk, CVAR, another risk measure used to assess the tail risk of an investment. Used as an extension of the VAR, the CVAR assesses the likelihood with a certain degree of confidence again that there will be a break in the VAR. It seeks to assess what happens to investment beyond its maximum loss threshold. This measure is more sensitive to events that happen in the tail end of a distribution, the tail risk. For example, suppose a risk manager believes the average loss of an investment is $10 million for the worst 1% of possible outcomes for a portfolio. Therefore, the CVAR, or expected shortfall, is $10 million for 1% tail. Alright? Kind of, difficult to imagine, but we'll see if we can find a better example. Alright? R squared, statistical measure that represents the percentage of a fund portfolio or a securities movements that can be explained by movements in a benchmark index. For fixed income securities and bond funds, benchmark is the U.S. Treasury bill. It's the risk-free investment. The S&P 500 index is the benchmark for equities and equity funds. Okay. Bond rating, equity rating, stock ratings. R squared values range from 0 to 100. According to Morningstar, a mutual fund with an R squared value between 85 and 100 has a performance record that is closely correlated to the index. Okay. Some sort of, passing percentage, 85 to 100. A fund rated 70 or less typically does not perform like the index, so underperformers. Mutual fund investors should avoid actively managed funds with high R squared ratios, which are generally criticized by analysts as being closet index funds. In such cases, it makes little sense to pay higher fees for professional management when you can get the same or better results from an index fund. Okay. So we have here categories of risk, although we've discussed this in a previous video, so just going to skip this, right? Bottom line, many investors tend to focus exclusively on investment returns with little concern for investment risk. The risk measures we have discussed can provide some balance to the risk-return equation. The good news for investors is that these indicators are calculated for them and are available on a number of financial websites. Okay, there are many analysis websites. They are also incorporated into many investment research reports. So if you are, in an online platform provided by banks or financial institutions, wherein you can trade stocks or bonds, normally they provide analysis reports on various types of companies and industries. As useful as these measurements are when considering a stock, bond, or mutual fund investment, volatility risk is just one of the factors you should be considering that can affect the quality of an investment. So volatility essentially is fluctuation in the actual results compared to the expectations. Alright, so that's it for this one. Thanks and bye.